am Kim Snyder, and thank you so much for joining me for the Sane Crypto Podcast, the first cryptocurrency podcast for baby boomers investing for retirement. Most people believe crypto assets are too risky for the average investor. I believe that the risk is in not investing, and in fact, cryptocurrency may be the answer to near retirees' prayers. The Sane Crypto Mastermind is my signature program for those of you who want the diversification benefits and return potential of cryptocurrency, but can't, won't, or don't have the time to figure this all out and keep up with it on their own. If you'd like to learn more, I'd encourage you to join my free online training called How a Little Bit of Bitcoin Can Make Your Retirement Savings Go a Lot Further at sanecrypto.com/retirement. So just this morning, I received an email from someone who registered for that free training. And he says, Kim, I'm looking forward to your webinar on Tuesday. I am actually in and out of cryptocurrencies at the moment. I bought Bitcoin, sold and made a little profit off of it, and have been hesitant to get back in. I have been thinking a lot lately about the question, why should I buy Bitcoin, and how I would go about answering that, not only for myself, but for others who ask me. It's an important question for me, as I actually work as a product manager at a cryptocurrency wallet company. The art of investing for the future is what I'm really interested in, learning to make wise decisions. Looking forward to Tuesday. So the question being asked here is, why invest in Bitcoin? And to take that one step further, I would just add, why now? So let's take them one at a time. I think that there are 3 whys and 3 why nows. The whys, as I've covered previously, for example, in episode 34 on the 3 ways Bitcoin reduces risk, are 1, that Bitcoin is a non-correlated asset to any of the other assets in a typical portfolio. 2, Bitcoin acts as a hedge against inflation and financial crisis. And 3, the upside potential of Bitcoin with even minimal adoption is massive. The 3 why nows are that 1, we are in the sweet spot of the adoption curve, meaning it's still early, but not too early. 2, Bitcoin's on sale. And 3, the big Wall Street players are starting to jump on board for real. So let's start with the non-correlated asset class. As you have probably heard me say by now, unless this is your first time listening to the show, correlation is a mathematical coefficient ranging from 1 to -1 that measures the relationship between the price movement of any 2 assets. The 3-year correlation of the S&P 500 to the NASDAQ, for example, is 0.95, very close to 1, meaning, as you would expect, that they are very correlated. They move together in lockstep. The 3-year correlation of Bitcoin to the S&P 500 is minus 0.01, meaning it is uncorrelated. There is no relationship between the 2 prices. And then as a third example, the correlation of a put option to its underlying stock is a negative correlation, -1, meaning as the stock price increases, the put price decreases. Okay? So the simple idea is that if we are holding a single asset in our portfolio with an expected rate of return of X, and we add a second asset that is non-correlated with the same rate of return, the risk of the overall portfolio goes down without affecting the return. And if we add a third, it goes down further, and so on until we reach the rate of, or the point of diminishing returns. Okay. So that's the first thing. Second is, while we are still working with a small historical time frame, because Bitcoin hasn't been around as long as gold, for example, we have seen Bitcoin act as a hedge against inflation and political upheaval, as we would expect in countries like Greece, Turkey, Zimbabwe, Argentina, and Venezuela. So all things remaining equal, and contrary to what your gut would tell you, Bitcoin reduces risk when added to a traditional portfolio. It does not increase it. But unlike almost anything else in a mainstream retail portfolio, Bitcoin has the potential for venture capital type returns, which is something that average retail investors don't usually get to participate in. The numbers are fairly staggering to this point. The historical rates of return of Bitcoin have been 1,395% in 2011, 200% in 2012, 5,525% in 2013, then minus 59% in 2014, 36% in 2015, 124% in 2016, 1,307% in 2017, and in 2018 year to date, we're down about 73%. Now, is that volatile? Yes, okay, but to expect that sort of return to happen in a straight line is unreasonable. That's not the way things work, okay? Remember that profit is always the return for risk. Will we ever see these sorts of returns again in the future? Nobody knows for sure, but there is a rational case to be made for yes, which makes it irrational to not have a small allocation in your portfolio. Okay? So those are the whys. And I think why is pretty easy for a sophisticated investor to get their head around, particularly once someone explains it to them. But what might not be so easy is why now? Because this requires us to override our lizard brain that is screaming, danger, danger, Will Robinson. Right? Now, the first thing going in our favor here is that we are, in my opinion, in the sweet spot of the adoption curve, meaning still early, but not too early. In 1982, I was one of the very first people that I knew to have a quote, air quote, desktop computer in college, if you could call it that. It was a K Pro 2, weighed about 50 pounds, with this tiny little screen with green text and a blinking green cursor, remember, and like 2 8-inch floppy drives, and it was hooked to this behemoth of a dot matrix printer, and that's how I printed my college papers. But it had a modem, and I remember spending hours dialed into CompuServe, exploring the forums and the message boards and playing simple games. And I tend to think of this as the CompuServe years for cryptocurrencies. You know, it's not easy, it's clunky, and most people have no idea what you're talking about or why you think it is so exciting. But, you know, all that was needed for widespread mainstream adoption was finally, you know, for AOL to come along and put a pretty gooey wrapper around it, and suddenly you've got mail, became a cultural phenomenon. And the next thing you know, the internet is so ubiquitous that we have no idea how we've ever lived without it. Some of you maybe never have, right? Depending on how old you are. So imagine that someone had given you a chance to invest in the internet back then. Not CompuServe or AOL. I mean, invest in the internet, okay? Well, this time you can. Only instead of the internet, it's the internet of money. Now, the second reason, and a hugely compelling one to me, is because the internet of money is not just for sale, it's on sale. In a recent episode of Hidden Forces with Dimitri Kofinas, which I highly recommend you listen to in its entirety, legendary value investor Howard Marks explains the idea of buying when everyone else is selling and selling when everyone else is buying, and why it is just so dang hard to do that.
The point is, we should like things more the lower the price goes. Buffett says, I like hamburgers. I eat more hamburgers when they go on sale. My wife goes to the sales. She buys more during the sales than she does in the non-sale period. We all should do that. And in microeconomics, there's a demand curve which shows that the lower the price, the higher the quantity demanded. That's the way it should be. But if you think about what I said at the beginning about the effect of emotion, the point is, as prices go lower, people regret their past mistakes, they rue their losses, they tend to sell out because they feel stupid, and they're afraid of further losses at just the moment they should be buying.
They see the decline in price of the asset which they already bought as a slight against that asset as opposed to an opportunity to buy more of it. Exactly.
And so in economics, there's the term Giffen good, Giffen. It's a good that is paradoxical to the laws of supply and demand. So maybe women's handbags are an example.
Snob goods.
Snob goods. And then if you turn it around, clearly people only buy stocks because they feel good about them. And then when the price falls in half, then they feel stupid and disillusioned, and they become more likely to sell. But if their premise was right, and it's always challenging to know whether your premise was right, you should like it much more after the price has halved. But most people find it impossible to do that.
Again, I strongly recommend the entire interview over on Hidden Forces. I'll put a link to it in the show notes for quick reference. I remember hearing Ari Paul, the former CIO, Chief Investment Officer of the University of Chicago Endowment, answer a question in a panel discussion. I am pretty sure it was at the 2017 Consensus Invest conference about when would the endowments, which is considered the cream of the institutional investment crop, begin investing in crypto assets. And his answer was when David Swensen of Yale does. Well, guess what? David Swensen of Yale just did. The crypto space has been waiting breathlessly for years for the institutional money to start making its way in, both because of the scale, the amount of money that these guys bring to bear. I mean, these endowments are hundreds of billions of dollars, and the social proof that it would provide, the legitimacy. In fact, there has been lots of news on the institutional front that has been dribbling out for several months now that doesn't really seem to be reflected in the market yet. But the three simultaneous headlines this week, that one, TD Ameritrade was investing in a digital asset exchange. Rick Edelman, a very large retail asset manager, who was initially very reluctant, if not against cryptocurrency, is now backing one of the cryptocurrency, Bitwise, which is a cryptocurrency index shop. And Yale has invested in two crypto venture funds. Does seem to indicate that the institutional money that we have all been waiting to see is not just a figment of our imaginations. While I was cutting my teeth as an options trader, I was constantly reminded that the easiest way to make money was just to follow the smart money, grab onto their coattails. But in this case, I think it makes some sense to try to front run that smart money just a little bit, because these markets are still so illiquid, particularly relative to the kind of money that these guys have, that it could get away from you pretty quick, as we saw at the end of 2017 when money flows start, even small ones by institutional standards. By the time you realize the train's pulling into the station, it could be long gone. So those are my answers, and let me just try to summarize them one more time, okay? So when someone asks me why they should invest in Bitcoin, my answers are, it's a non-correlated asset to any of the other assets. Therefore, diversification reduces risk. It acts as a hedge against inflation and financial crisis. Again, about risk reduction. But it also has this massive upside potential, similar to what you would see with venture capital type returns, which is not a given, but certainly possible with even minimal adoption. Once in a lifetime sorts of return potentials. And when someone says, as they often do, but you'd have to be crazy to buy or to invest now, well, my thought process, for better or for worse, personally is, well, okay, one, we're in this sweet spot of the adoption curve, still early, but not too early, kind of the CompuServe days. 2, Bitcoin is on sale. And that's the really big one, and also the hardest one for people to wrap their brain around, because people want to sell here, not buy. And then 3, the big Wall Street players are starting to jump on board. It looks like for real now. Now, of course, there are no guarantees, right? As Howard Marks recalls in another part of that same interview that I played for you, Charlie Munger telling him at lunch one day, just remember, none of this was meant to be easy. And anybody who thinks it is easy is stupid. Right? Okay, so yeah, anyone who tells you that they know what the market is going to do is lying to you and themselves. So the trick is to position yourself so that you balance the opportunity cost of missing out with the potential for losses, given the specifics of your situation. If you learn how to do that, as the old saying goes, you have nothing to fear and everything to gain. As always, I hope that was helpful. All right. I am sure if you're a podcast listener, you have also heard me and other hosts ask you for iTunes reviews. And that is because these reviews, yeah, they make us feel good, but they are really important to the iTunes algorithm. It helps the algorithm know to show this, or, expose the show to more people. Otherwise, it just ends up in a black hole somewhere. So if this was helpful for you, I am asking you to please take a moment to do 2 things. One is to subscribe to the podcast, because that matters. But most important is to leave a 5-star rating with comments and feedback, because that engagement really triggers a lot. And it also, it tells people like you that we are creating content that you find useful and valuable. If you want to tell people why that is, that would be great. Also, if you'd like to learn more about striking the right balance in your cryptocurrency investments and my system for doing that, then I recommend my free online training, which is called How a Little Bit of Bitcoin Can Make Your Retirement Savings Go a Lot Further. You can find that at sanecrypto.com/retirement. You can get the full show notes of this episode, including links to the Howard Marks interview and any and all resources mentioned or used. You will find that at sanecrypto.com/podcast. And then finally, if you have a question about today's topic or anything else, just email me at askkim@sanecrypto.com. I read and answer every email personally, as well as answer some of them here on the show like I did today. Everything I say on the show is for educational purposes only. Nothing should be considered investment advice. Past performance is no guarantee of future results. All investments involve risks, so do not, under any circumstances, invest money you can't afford to lose. That is it for me. I am Kim Snyder, and I'll be back next week. Until then, may the crypto gods continue to smile on us all.